Fed Jerome Powell again is facing political pressure as worries mount over the economy. This is coming on the same day today that the Bank of Canada hit the markets with a smaller than expected rate hike. This is really what the markets have been so gung-ho about, the possibility of getting a smaller rate hike than 75 basis points. And that's what the Bank of Canada just did, citing again fears of a recession. So when you put this into context in our markets, is the optimism really overblown, or could we potentially see a Fed pivot right around the corner? We're going to talk about that, get into the whole situation, but also I want to talk about Apple, because Apple is potentially the bad apple that fell from the tree if they have bad earnings tomorrow. And we're going to talk about the earnings expectations for Apple as of 10 hours ago and what analysts are thinking and potentially what could happen, because we just seen Facebook earnings and they are down another 25% today. And I say today, it's about to cross midnight right now, but when I'm filming this video, so if you guys are seeing it, you could probably refer to today as yesterday, but it was not good. And it really wasn't too far off of what the expectations were for Facebook. But there is no love in this market if you miss on earnings. So let's get into all of this information. If you guys want to come trade with me live in real time, link down below in the description of this video. But most importantly, hit the like button and subscribe to the channel and comment down below, because all three of those beautiful things are free 99 for each and every single one of you guys to do. Nonetheless, let's get into this situation. So a little bit of a backstory on why the markets have rallied from the low of the market since we just seen a couple of weeks ago. It's really due to one thing, and that is rumors about the Fed slowing down the pace of rate increases. And these rumors are really warranted because this has been the most aggressive rate hike cycle that we have ever seen from the Fed. They've been raising rates very dramatically, first with a 25 basis point rate hike, next with a 50 basis point rate hike, and then we have seen 3 back-to-back 75 basis point rate hikes, and we're expecting a fourth 75 basis point rate hike. Markets are saying, hey, you've tightened so aggressively, it's going to be, 300 plus basis points by the time 2022 ends. And the markets are saying, hey, you've done a lot. You've done a lot of damage already to the economy. We will feel 3, 6, 12 months down the line, and you're probably going to stamp out inflation. At this point, the risk to reward ratio doesn't make a lot of sense to continue with these 75 basis point rate hikes. And you've seen some Fed members like Fed Daly and some other Fed speakers come out and say that, yeah, maybe we should slow down the pace of rate increases. So that is something that deserves some credibility, at least when Fed speakers themselves are talking about giving you smaller rate hikes. That's something the markets should care about, and that's why the markets are off of the lows. That's as simple as it is, because the bond market really for a second there was going through a liquidity crisis. The bond market was really faced with a dilemma. How high do rates need to go? Where does the 10-year treasury need to go? Because the Fed's just raising rates to oblivion, right? That's a big question mark, and that's why the bonds literally were going straight down, and that's why the markets were also going straight down as well. So guys, let's get into this new, more relevant information, because let's be honest, the markets don't even care about what happened yesterday or last week. They care about what's going to happen tomorrow with Apple earnings. They care about what's going to happen next week with the Fed. And as of right now, Fed Powell again is facing political pressure as worries mount over the economy. And the key points: Senator Sherrod Brown this week sent a letter to Fed Chair Jerome Powell expressing concern about the impact interest rates hikes could have on employment. Quote, potential job losses brought by monetary over-tightening will only worsen these matters for the working class, the Ohio Democrat said. The last time the Fed raised interest rates from 2016 to December 2018, Powell withstood withering criticism from former President Donald Trump. Powell has in the past been generally dismissive when asked if political pressure can factor into decision making. And this is probably not going to play a big role into things, but I would not be surprised if you continue to see more people on the right, on the left side of the political spectrum, or just really anywhere in between, trying to say things because the midterm election is coming to really make Powell feel the pressure because some of their seats are in jeopardy. So that's kind of what you should expect to see over the next couple of weeks. And these things, believe it or not, can move the markets if there is a logical reasoning about it, right? For an example, just a quick example, we're not going to ramble about this for too long, but that's like iceberg research, right? When they come out and make a short report, or Citron come out and make a short report, it's not 100% true what they're saying, but the story makes sense. So those stocks usually react very negatively, right? So that's why it could be important, and that's why we're talking about it here in this video. But something that is really more credible is the Bank of Canada slows pace of rate hikes as recession fears mount. And it says, as of today, the Bank of Canada announced a smaller than expected interest rate hike on Wednesday, and it said it was getting closer to the end of its historic tightening campaign as it forecast the economy would stall over the next 3 quarters. And I think this is a central bank that is really being more realistic than our Fed. Our Fed has this rosy picture painted of almost 3% GDP growth next year. It's not going to happen. The Bank of Canada, I think, is a much better gauge to what they actually think, right? The Fed's not stupid. Let's be honest there. They know growth is not going to be 3% next year. They put that bullshit out there so the markets can, handle rate hike increases. So the markets can say, yeah, we need to raise rates, and without a real freak out panic liquidity crisis happening overnight, basically, right? Now, it says the central bank increased its policy rate by 0.5 percentage point to 3.75%, coming up short on calls for another 75 basis point move. It has lifted rates by 350 basis points since March, one of its fastest tightening cycles ever. And if you look at this chart where it has most of the developed countries' central banks, you can see that central banks are all ramping up their fight against inflation, besides Japan, because Japan struggles with deflation. Japan savers, and hopefully you guys know the situation with Japan. If you don't, let me know down below in the comment section. Very interesting story to learn why Japan is Japan, why the yen is the safety currency of the world, things of that matter. But that is neither here or there for this video. And you can see that the only country that is behind Canada is us. And now we're behind Canada because they just did a 50 basis point rate hike. But before then, we were both at 3% interest rates. That's where we are right now, neck and neck. They did the 50 basis point rate hike. So if we do a 75 basis point rate hike, that's going to be more than Canada. If we only do a 50 basis point rate hike, that would not be priced into the markets. You'd probably see a massive short squeeze if that did happen. That will be next week, I believe. It's on Wednesday. It's on the 2nd. Wednesday, November 2nd, that we will hear from the Fed and get that rate hike. But nonetheless, the United States and Canada are pretty interconnected as far as economies, as far as, inflation, and just overall Fed ideology is pretty much the same. That is our closest ally, and that's really the one I would pay attention to the most, and I do pay attention to the most in regards to monetary policy, right? But it does say, in quote, this tightening phase will draw to a close. We are getting closer, but we are not there yet. Governor Tiff Macklem told reporters at a news conference after the decision. How much higher rates need to go, quote, will depend on how monetary policy is working to slow demand, how supply challenges are resolving, and how inflation expectations are responding. Now, this is key, and I think this is the most powerful paragraph in this article, because our monetary policy is slowing demand. It's obvious to see advertisers slowing down, company earnings not coming in, year over year gains as much as they were. You're seeing 2-3% revenue gains and growth overall with a lot of subscriber companies from last year's third quarter, right? So you're not seeing that same demand. So the demand's definitely being slowed. Even look at real estate. This is the least amount of mortgage applications since 1997. That means after the 2008 real estate crisis, there was more people trying to buy a house then, when there was mass panic, mass bankruptcies, mass just fucking fuckery going on in the economy. More people trying to buy a house then than now. Obviously, they are slowing demand currently. And it says how supply challenges are resolving, and I think that's pretty clear to see. You know, things are getting better on that front. I would say they're really good relative to where they were just 6 months ago. And then it says how inflation and inflation expectations are responding, and that's the biggest thing here, because we have not really seen inflation tick down, which the Bank of Canada really has not as well in a big way. But inflation expectations have been going down for inflation expectations over the next 1, 5, 10 years. So that is very positive. And I think, you know, that does lead some credibility to maybe it's time for our Federal Reserve to get along the same lines as Canada. And this could be a foreshadowing of potentially what could come either next week, or at least at the very minimum, what the Fed has to say about future rate hikes, because I do think they will provide some level of guidance. But before we get to next week, we got the bad apple, which could be Apple earnings themselves. It says the key takeaways: Apple's Q4 earnings per share EPS is estimated by analysts to reach $1.27 versus $1.24 in quarter four full year 2021. Apple's Q4 services revenue is expected to rise nearly 10% year over year, topping $20 billion. Revenue for Q4 at Apple is projected to grow 6.3% from the year ago quarter to $88.6 billion. And there has been a lot of rumors as of late that Apple is potentially cutting iPhone demand, and that's very interesting. If you're expecting to see 6.3% year over year basically quarter over quarter growth, is that really gonna happen? Who knows? All I know is that if you do not beat all expectations, just everything is picture perfect rosy, you are at a risk of dropping 10 to 20%. Look at Google, look at Facebook, look at some of these other companies that beat on revenue but miss on quarter over quarter growth, right? One small factor could be the deciding factor for the rest of this week and for the markets. And the light just went out. I think that means it is time to wrap up this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Yes, thank you guys for watching. Enjoy the rest of your nights. Enjoy your mornings. I will see you in the next one.